Will they or won't they raise rates on Wednesday? This is Corey Rosenblum, and you're watching the Theo Nightly video for December 18th, 2018. And that is the question. Will the Federal Reserve keep with their stated policy goals and what they've said they would continue doing, which is raising rates throughout 2018 and very favored to do so in December? That's tomorrow, the 19th of December. Or will they do something different? But that's not the only question we're going to ask in tonight's video. We'll also ask, what will the net effect be on the equity market, the stock market? Will it rally, bounce away from our little pivots? And the bond market, which is going to be TLT, ZB, and the like. Will bonds rally up through here, or will they fall? We'll start with the S&P futures. A quick update takes us through our gravity spots down beneath our extra gravity at 2575. We are currently beneath them and playing out the alternate thesis on high bearish volume. And that is the market has failed to bounce, as would have been expected, off of 2626, 2600, and it is now at new lows for 2018. We always state that if something should happen but doesn't happen, it often leads to a larger than expected move in the opposite direction. And that is a way to protect ourselves in case something unexpected takes place, or profit from it on the intraday charts or with open option positions. Tomorrow they will make a decision whether or not to raise their overnight interest rate, and it will be the focal point of the financial market, including us here in TheoTrade. So will they raise, and what might they guide about where they assess the economy is likely headed? I think tomorrow's statement will be critical. It's obvious, it's really easy to say, oh, they'll just raise rates, but things have changed. Things have gotten a little bit more complicated in the environment and in the economy since their last meeting. So it seemed like it was a slam dunk to predict and forecast and be ready for a rate hike at the end of the year. Well, that's not necessarily the case as we push one day out from the Fed meeting. All right, so again, the S&P, this is the futures, are down at 2018 lows. That was not the case at the last meeting, and these are accelerating lows with rapid expanding volume. And this is for multiple factors, some of which include the possibility or chatter or talk or future thought process of a declining economy or a stagnant economy that is starting to take shape. And if that is the case from the economic data, well, the Fed might choose not to raise rates tomorrow. And that'll be part of our decision about whether to play long, short, or to stay out after and before the meeting. Nonetheless, just one perspective on the weekly chart shows us why this level, 2535, 2500 especially, is vitally important, because there's nothing else left. The equity market in 2018 started strong, pushed into a weak period, started very strong in the middle of the year, and then we are currently extending a weak period. And again, there's just not a lot there beneath current levels. So what happens tomorrow is very important and could be the determining factor about whether we bounce and play bullishly up away from, or fall into the abyss, which keeps our bear positions profitable, and any type of selling premium, other strategies that take advantage of a falling market, in out spreads, any other type of hedges or disaster planning. That's the equity market. Let's take a look before we discuss the Fed policy on ZN, and that's your 10-year Treasury note. ZN is a futures contract. So it is into the upper part of resistance, and that's fine. It's about the 120 level, and it is at the top, this is a weekly chart, of our horizontal band for the bulk of 2018. Note that equity prices did well and then fell. Bond prices typically track opposite, for the most part, the equity market. We've had a flat to up until recently equity market, but the bond market, in the specter of raising rates, has declined until recently. And that's going to be something we have to keep watching. It was also in a prior video, and we're updated from that last point. Bond prices keep getting stronger on high volume. That's not something you want to see if you're an equity market bull. We can also look at ZB, and that is the 30-year note from the weekly perspective, a downtrend from 2016 all the way to present. Remember, when the Fed raises rates, they don't control the longer-term bonds, they control the overnight interest rate, Fed funds rate. But that does trickle down throughout the economy in multiple ways. But just quick reference, higher interest rates put pressure, bearish pressure, on bond prices. Lower interest rates or flat or stagnant interest rates put upward pressure on bond prices, all things being equal. Another factor, bond prices rise when the economy stumbles and when traders and investors want to engage what we call risk off or protective behavior. That's something we've seen spectacularly at the end of 2018. So please keep this in mind. Let's take a look at our Fed grid. This fancy little chart will get the job done for our purposes. We're looking at the left side of a decision chart, and we're going to think that we're going to assume that the Fed chooses, looks at the data, and they raise interest rates a quarter point tomorrow. There is a 73 to 75% chance based on futures and other analyses that they will raise rates tomorrow. Therefore, we're going to expect them to raise rates tomorrow. They will be tacitly saying that the economy is good, that these inflation worries are more important than stopping an equity rally or otherwise putting pressure by taking liquidity out of the economy. So if they raise rates as expected, they will tacitly be saying the economy is good. And that could trigger a stock market rally with a bond market decline. We don't know these things. These are, of course, projections, but we know that if they raise rates, they will be tacitly admitting that the economy is good, strong, strengthening. All right, so that's what we're going to look for a rally off of support in that example and for a bond market decline. Doesn't have to happen this way, but that's your general thought process. If the Fed chooses, based on the data and information that they have, not to raise rates, 25, 27% chance based on futures, that would be a tacit admission that the broader economy is weaker than we expect it, or weaker than we're seeing it. And that maybe would be a knee-jerk reaction, a stock market surprise. Oh, they didn't raise rates. We thought they were going to raise rates. Well, that's really bullish. That's more liquidity in the broader economy. So you may see a quick rally in the event that the Fed does not raise rates. But I think that after some time, they realize what that means, and it's this. The Fed is looking at the data and saying, oh no, the economy is weaker than the public sees it, or that the current data is assessing, and we think the future is going to be weak, so we need to help that economy and not hurt it. And so we will keep rates the same. You may see an equity market boost that turns quickly to the downside. And if that case, if they don't raise rates and lower rates are stimulative or boost bond prices, you probably will see a bond market rally for two factors. That one, that the unexpected move took place, which could send bond prices surging, and they did not raise rates. That also is bullish for bonds. But if the general consensus or general wisdom is, oh, they didn't raise rates because the economy is weaker, then you'll probably see a flood of money into the bond market. These, of course, are projections based on what the Fed does, but it gives us some ideas of what to do, how to position on our products. So bond market could flow to the 145 index level or push down away from it. That's ZB. TLT, which watch what happens at this midpoint at 120 per share. Either it surges a little bit higher, 120.50, 121, all the way to 122, or pushes back to the 117.50 level. And of course, how it plays out on the ES futures and other products like the Nasdaq. Will the equity market bounce, rally? If so, 25.75, 2600, 2626, all the way to 2678, 80 and above, even 2700 into the end of the year and to January. Of course, if that doesn't happen, we'll have to look at the weekly chart for downside targets, and there just aren't many beneath 2500. Take care at TheoTrade. Let's all watch this together tomorrow and adjust accordingly with what the Fed does and how the markets react.